Hello, hi, I'm Nick Burgess. I'm a quant analyst, and today I'm going to talk to you about American options trading and analysis. And the way we're going to do this is I'm going to show you some PowerPoint slides and give you some overviews of how to the IB Broker trading platform, which is one of many brokers that we can use. I also show you then some example workbooks in Excel of how to price options and how to create trading strategies. And then I'm going to show you that in sort of PowerPoint format. And then we're going to jump on and show you a live trading screen in IB Broker. And then I'm going to show you how to replicate those prices and how to set up your own trading strategies using an Excel example workbook with full implementation of pricing and risk analytics in Excel. So I'm going to share my screen, going to take you through the slides, followed you by some live screens, and then sort of concluding with how to sort of create our own strategies using an Excel workbook and replicating those live prices. So we'll move in that direction. Give me 1 second. I'm going to share the screen. Okay, so here we are. So let me go full screen. Here we are. So this is part 4 of our series. So we're going to look at interactive brokers, and we're going to look at live option pricing and how to replicate those prices in an Excel workbook so that we can create our own trading strategies. So now this so this is the 4th part, as I mentioned. So in part 1, we looked at American options trading. We looked at US equity option markets in particular, and we did look at some live trading strategies. I showed you how to get the prices for options for live trading of options using IB Broker. We looked at the option chains. We looked at the screens, how to get the implied vols, how to sort of place our orders, and we also looked at the Greeks, which is used for risk management and scenario assessment. Now, part 2, we looked at, which is the second series in our video, we looked at trading strategies, and the trading strategies that we saw in IB Broker, we went through, we categorized them into directional trading strategies, income trading strategies, range trading, and spread trading. We looked at those different trading strategies that are available in IB Broker. Then part 3, we looked at more theoretical side of things. We looked at the pricing of American options and the optimal exercise sort of components. So when we're pricing American options, the main sort of aspect, the main thing that we're trying to evaluate is how to optimally exercise. Do we exercise now, or if we wait a little bit longer, would we make more money? Because when you exercise an American option, you actually have to sacrifice and give up the time value of your option, and you're just deciding, is it worth doing that or not? And there are mathematical ways of doing that. We showed how we talked about delta and the probability of exercise. So if you short an option, what's the chances of you being assigned against? And if you long an option, also what's the chances that you're going to sort of exercise and be in the money? We looked at, to gain intuition about optimal exercise, we looked at Cox-Ross-Rubinstein trees, which is a type of binomial tree. It's one of the simpler ones. And using such methods, it gives us a lot of intuition and makes the theoretical sort of understanding of pricing American options much simpler to sort of understand, and it also sort of makes it much easier to understand whether to exercise an option optimally, whether do we exercise now or later. And it sort of makes that sort of very clear. So it helps us in our trading. Now, part 4, which is what we're going to look at today, we're going to look at how to price options in an Excel workbook, and the prices that we get in our Excel workbook are going to match the prices that we see in trading venues on trading platforms like IB Broker. So we're going to look at some of the live pricing, and we're also going to look at how to sort of replicate that and sort of customize trading strategies in an Excel workbook. The workbook we're going to be using is here at the bottom, so there's a link. This is optional, so feel free to sort of use that or follow along on the video series. So so that's what we're going to look at today. So interactive brokers, live option pricing in Excel. So firstly, interactive brokers is one of many brokers that we can use for live trading of options. Now, some of the features that they offer, you can trade stocks, futures, FX, commodities, and options, mainly equity options. There's a rich set of features and analytics. The execution fills are very good in my experience. Transaction costs and fees are quite low, are very are pretty good actually compared to other platforms. They're very good for transaction costs. The software is excellent. They have a mature platform called Trader Workstation or TWS. That's pretty mature and very solid workstation to work with. And then they have a very modern desktop, which is pretty new. And then they have a mobile service, and they also have a server platform called IB Gateway, and that's great for algo trading. They have several APIs that you can use for algo trading, and I like to work with the Python API. Now they have a rich set of documentation, videos, quant guides on their trader platform on their website, and a lot of videos as well, so explaining how to use things. So I find that very useful. So it's a really well thought out sort of platform, and there's lots of support available. So that's IB Broker, IBKR. Now, when I want to replicate prices that I see in IB Broker for live option trading, I have a support workbook that's very helpful for me to work with, and I've sort of I streamlined that workbook and I made that available to you, which you can sort of find here on the link. Now we offer some of the features in this workbook. You can price options, and you can also assess the Greeks. This is for European options and American options. Most US equity options are American style, so you have to bear that in mind. And the US indices are typically European. So you need to be able to price both sets of options, depending on whether you want to trade equity indices or equity options in US markets. The workbook has trading strategies. We can price the same trading strategies that we find in IB Broker, which I'll show you in a second. But I offer for American options, we have analytical pricing, and there's quite a few different sort of pricing methods that we have for American options, and you kind of have to pick which one you prefer to work with, because it's quite difficult to find anything that's going to sort of give you an exact price. Everything will be kind of pretty close, and there's pros and cons of each approach, and I'll explain those to you shortly. So analytical pricing, we can do that. We have a Monte Carlo approach implemented for American options too, which is called the least squares Monte Carlo. We have a tree method. We have two tree methods, which is Cox-Ross Rubinstein, which is the basic sort of binomial tree, which is very good for intuition. And we also have the Lyson-Rama tree, which is one of my preferred methods that I like to work with. And that's definitely my favorite one. I recommend that to you as well. These spreadsheets also, we compute the exercise probability, so the probability of being assigned if you're short, or the probability of exercising your option if you're long. We use the CRR, the Cox-Ross Rubinstein model, to illustrate optimal exercise. It's a very good model to work with because it's very easy to customize. It's accurate, and it's also sort of pretty basic, but at the same time it gives you good pricing intuition, and it really helps you understand American options quite well. So I'd like to work with that from an educational perspective, and then use the Lyson-Rama tree for live trading. And the only real difference between the two trees is that the Lyson-Rama tree, my preferred method, it incorporates some important sampling, and that sort of means that when you're pricing your American options and when you're sort of simulating your tree, instead of building your tree around the spot price, you build your tree around the strike price. And that sort of means that when you're sort of simulating paths through the tree method, you cross over your strikes more often. And so if you're pricing sort of options that are deeper out of the money or deeper in the money, it gives better pricing in those circumstances for those options that are not at the money. And then finally, in the workbook, I'll show you, I'll reconcile the prices where I'll show you how to sort of get back to the same prices that you see in the Interactive Brokers website. The workbook is available here. That's optional, but should you want to sort of see it, work with it, it's available here in the link. Now, when you're pricing options when you want to sort of get option prices from broker platforms such as IB Broker, we look for something that's called an option chain. We discussed that sort of previously. And here's the option chain for a stock a US stock called XOM. That's ExxonMobil, which is an oil refinery company trading in the US markets. So ExxonMobil. And what I'm looking at here is this at the time of the snapshot, this stock trading at 11137, which you can sort of see up here on the right. And then in terms of the option chain, which is what we see here, calls are on the left, puts are on the right. So in this case, I'm just going to sort of try and replicate a put price. So my puts here on the right. So I'm looking at the right side, and then strike maturities are in the middle. I'm going to look for the November 21, 2025 is my maturity. That's going to be a Friday. And I'm going to look at the 95 strike. And if you look over here on the right, you'll see the bid and the ask. And as we sort of mentioned before, whenever you look at option prices, you're looking at the unit price. And one option contract gives you the right to buy or sell 100 shares. So you have to multiply this by 100. That 100 is called the lot size. So it's 56 cents per share to it's 56 cents on the sell side, 62 cents on the buy side. For this option, you're going to get the right to buy sell 100 shares. So in terms of the premium, you have to multiply by 100, so 56. So if you want to sell that one option contract, you're going to get $56, and you have to pay $62 to purchase. And you sort of see that down here in my Excel workbooks snapshot. So here on the right, sorry, on the left, is what I have here, this a paster on top of this screenshot, a snippet from the Excel workbook that we use for options pricing. And I've pasted in, so I copied in the bid-ask spread, which you sort of see here, 56 and 62. And I just populate my template, and I'm going to get back an option price. In this case, I get back an option price of 58 cents, and that's between the bid and ask, and that's a good price. Now, the reason why we don't get exactly the bid or exactly the ask is because the implied vol here, we should really have an implied vol for the bid and for the ask, and I only see like some kind of mid implied vol. And so this is not the at the money vol, which is 21.9. This is the volatility for this particular strike, which is 27.8. So I populate the parameters here. So the put option, spot is 11137, strike is 95. I've got 73 days to option expiry, which you can sort of see here. It's Act 360 basis. You basically just divide 73 by 360 to get your time to maturity, so that's 0.2. Risk-free rate's on another 3, and I'll show you how to get that shortly. And the cost of carry is just the risk-free rate minus the dividend yield, so that's 1. Volatility, I'll show you how to get that as well. Volatility is 27.8, which we sort of took from here, and that's not at the money volatility, that's the volatility for the strike. For your option strike, and then if you put those parameters in and refresh, you'll get an option price of 0.58, and that's between bid ask, as I mentioned. That's a very good price. The probability of exercise is 10.83, 10.88, sorry, and so I like to sell options, and when I'm selling options, I like to sell them sort of with a low probability of exercise because it's an income generation strategy in my perspective. So when I'm want to sort of sell an option for income, I'm looking for income. So I'm looking for stocks that are either trading sideways or mildly bullish. And this, if you look at ExxonMobil, it looks kind of stationary, very sideways moving. So that's perfect for me. The other reason why I like trading this particular stock is it pays really good dividends. If you do sort of go long and you get exercise, you typically you get to sort of receive those very large dividends. You can see the deltas here sort of very closely matching. So you've got minus 0.89 and you've got minus 0.69. Now again, this is just not exactly matching because we don't know the exact implied vols to use for the bid and ask. But we do, but we should always get something sort of prices between the bid ask, and we should always get them very close for all the other risk parameters as well. You can see here we're matching very, very well with interactive brokers. And the reason why we want to sort of do this in Excel, we could just take the prices off the screen. That's perfectly fine. But when you're in Excel and you have the ability sort of to price your options for yourself, you can actually you can run some risk scenarios, and you can also create your own structures and customize the deals to pay the exact premiums that you want to pay. So it really gives you a lot of flexibility to structure and customize your own trading strategy. And that's perfect, exactly what we need to trade profitably. Now, this is a screenshot. What I'm going to do now is I'll show you how to get to the same screen on the live platform using the simulated account, and then we'll jump into Excel and I'll show you how to price the options there as well. So let's do that. So if I jump into interactive brokers here, so when you see this red banner at the top, this means you're in the simulated page. That's always something worth checking for because we jump between the two, between live Sometimes you want to practice your trading strategies before you go live. So just watch out for this red banner to know if you're live or simulated environment, just so you know what you're using. Okay, so I'm in the simulated IB broker account. So you can see ExxonMobil here. I've just keyed it in XOM. Now, if you right click on here, let's do that. And you can pick the option pane. Let's do that. Sorry, it's lagging a bit. There we go. There you had it already open. I think that's why it's doing that. So it'll pull up the option chain for ExxonMobil, and the option chain is where you see all the is where you see your option prices. It's called a chain because you see a chain, you see a series of options for different maturities. You'll see a pop. You get to pick the strikes you want to see and the months you want to see. You can see list view, tab view. If you go for tab view, it's sort of you put your expiries sort of side by side. So you see that sort of horizontally, you have to scroll across, and that's why. But I like to work with the list view, so I'm going to switch back to that. I'm just making you aware that that's there now. And then when you go into list view, you'll see your strikes sort of going down the page. And I'm interested. We were looking at the November 21, 25. That's all not far from sort of expiry. Now, the different colors here mean something. So yellows are the weekly expiries, and whites are the monthly ones. And the monthly ones are more liquid, and you tend to only find the weeklies on the short end. There are more expiries that you can see here, but so you can pick on the drop down. You can sort of see more expiries if you want to see them. So I'm just looking at some of the shorter data options. Now, as I said, the calls are on the left, puts are on the right. You see a bit arc, and you can customize these columns here. So there are more columns that you can see. So these are you can see your implied vol. At the monies are on the tabs, and then these red ones are the implied vols for each of your strikes. And if you want to sort of trade, you just select the bid or the ask that you're interested in. So you pick a bid, it will take you to it will populate that in your order entry, which you sort of see up here, and you can buy also, and that bid is being your sell, and then you can sort of pick the price that you want to sort of place, whether you want it to be adaptive, which you use an algorithm. With the cancel, you can say if it's the limit or a market order, and then you can also see the cost impact, how much margin you're going to put aside, and all the rest of it. You press submit, it should take you to a hold screen first, so you can check commissions and transaction costs, and then you can execute from there. Executions will then show on the bottom left. Now, if we go back to the option chain itself, so you pick bid. Now, nothing's going to happen unless you highlight a bid or an ask, and then you sort of see the colors showing up. You click on that, it will take you to your screen. Now, you'll place it in your order screen, so you can sort of prepare your order. Now, if you want to build a strategy, which is what we're going to do, you turn on the strategy builder down here on the left. And what we're going to look at in our Excel workbooks shortly is how to replicate these strategies so that we can customize them and structure our deals, which you can't easily sort of do otherwise. So you've got all these different options here. You can do box trade, butterflies, calendar spreads, diagonal spreads, straddle, strangle, synthetics. It's different choices. And so if you would say, for example, you want to pick a straddle, so you pick your straddle, and then nothing happens until you sort of hover over things. And now, if I hover over the bid of a call, you'll sort of see it'll hover over the bid of a put as well, and you sort of see it's picking. So it allows you sort of to pick the two legs that you need for your straddle, where you're longer call, longer puts. In this case, I'm going to be short call, shorter puts. If I hover over the arc, I'll be longer call, longer puts. And you can sort of pick and choose you pick one leg and it automatically sort of finds the other leg for you on the left, which is pretty good. Now, when you're ready, so we see it's trading 1149 currently. We took the snapshot, it's at 111, so that's taken a couple of days ago. Now, if I want to go longer straddle, say around that money, you click on it and then it'll populate the strategy builder here at the bottom. Now it's got here, and it's going to sort of pick this as let's just make sure. I normally see this come up as two trades. I'm wondering why I've only got one. Let me do that again. So I'll clear the legs, pick the straddle, and then I want to buy at the money. So I'll pick the R's. I pick that down. Yes, and this is what I'm expecting to see two trade. I must have clicked off the straddle. So now I've got two trades. It's going to execute it as a single trade. And you see the bid and ask here. And it should reduce your transaction cost potentially from executing it as a single trade. And it'll come up as then as a straddle on your trading page. You can press profile where you can sort of then see what the trading strategy looks like in the P&L, and replicate this in Excel as well. It tells you your break evens. I give you some scenario analysis here at the bottom left as well, and we can do all of this in Excel, which is brilliant. So this is really useful. Now, you can add this to your watch list and then trade it off the watch list, or you can clear it and do another trade, or you can actually even execute it at the bottom here on the left as well. So I prefer to put it to my watch list and then sort of trade it off the main dashboard because just the way I like to do it. I'm going to clear these legs, and I just want you to basically, why am I showing you this screen? Firstly, I wanted you to see how to find the code for options. I do like being on the list view, so I'll switch you back to that. I wanted you to be aware that there's a strategy builder, which you sort of pick in the bottom right of your option chain. And then you can also pick your trading strategies here. And there's quite a few of them. You can also sort of customize your own trading strategies as well, but then you have to execute the legs individually. So there's some execution risk there. But that being said, I would, if the market's not too heated, it should be fine even executing those legs separately. No, it shouldn't be a problem. Right, so this is the trading screen. This is what I want you to be aware of. This is how we sort of view the prices of options, and that's how we trade them as well. So now I'm going to jump back in onto the Excel workbook and show you how to sort of replicate these prices what we were just seeing on the IB Broker screens. So let's jump onto the Excel workbook. So I've split this workbook into two sections. We've got the black tabs are European options, and the reds are American options. And the way this works in US equity markets is that the US indices are European style. So you want to trade the S&P index, it's going to be European style option. And generally all the individual stock names, they're American. So they're quite different. And the difference being the European options, you can only exercise maturity, and the American options, you can choose when to exercise. And you have to then sort of decide how to exercise optimally. Should I exercise as soon as I'm in the money, or should I wait a bit longer and make a bit more? And whenever you exercise an American option, the important thing to bear in mind is that you're going to make the difference between these you're going to be your profit's generally going to be the difference between your spot price and your strike, and any sort of extrinsic time value so if you still got sort of 6 months to go on your option, you're giving that up, and you're having to decide, okay, am I in the money enough for that extra time? Is it worthwhile? Should I exercise later or shall I exercise now? And quite often what you find in the American option, when people are trading American options, they just don't exercise. I always find that pretty strange when I first started trading American options. How come I'm never assigning? And the reason for that was instead of assigning and sort of exercising my option early, you can just sell the option. And that way you capture sort of the intrinsic and the extrinsic values. You capture the difference between the spot and strike, and you also capture the time value. So instead of giving up your time value, why not just sell it? So that's what most people do. And there are certain reasons why people might not choose to do that, which we'll talk about shortly. So blacks are European options, which is typically going to be the US sort of indices. And then for this equity stock options in the US, you're going to be using the red screens, which are for the American options. We've got a tree in the middle here, which is going to sort of help gain intuition about when to exercise if you want to exercise, or how to gauge whether someone's going to assign against us if they sold an option. So that's just to help us gain intuition. And then I've split these into sort of two parts. So when we see the 2D pages, what we're going to sort of see is like the payoff profile. And when we go into the 3D pages, we're going to sort of see more of a scenario. What if this happens? So what if stock prices fall? What if they rise? How does the option look like as we go further out in time? So you can sort of run more. It's more to give you a sort of a scenario sense of what might happen. Then what we also have for America and European options is the different strategies, and these are the strategies that we typically see in IB Broker, which we just looked at. So the call box trades, butterflies, risk reversal, the iron condor, all the different sort of trading strategies they're set up here. I'll show you how to customize those, and we have those for Europeans and Americans. And then also at the end, and I'll show you how we reconcile the prices with IB Broker as well, so you can sort of trust what you see. Now, everything that's in here, we've got VBA analytics behind this as well, and in sort of future videos, I'll be sort of making available C++ code for this as well. But what you sort of find if you go into the Visual Basic, Now, how did I get to that screen? So I'll just show you very quickly. If you go to the developer tab, you press Visual Basic, and then you'll sort of see in the module section, you'll see the different sort of code I've implemented for you. So we've got Berks and Stenciling, which is for American options. This is like an approximation, an analytical approximation. It's a very good one. It's not 100% exact, but it's very close. We've got the distributions we need for pricing options. We've got European options, which is the Black-Scholes formula and risks. ND2 is the probability of exercise, and we've got quite a lot of other analytics in there. We've got a Lisa Rubin tree, which is a bit like a Cox-Ross-Rubinstein tree, but except that it's using importance sampling, gives better pricing of options when they're deep in or out of money. And then we've also got the Longstaff chart, which is a Monte Carlo, least squared Monte Carlo approach. It's very robust. But it requires computational power because it's running a Monte Carlo can sometimes be a little bit slow. If you're pricing one option, completely fine. So we put that there for completeness as well. So all of that's available, and we use that in the workbooks. So starting with the 2D Black-Scholes, here what we can do is at the top, we can put in the number of options. So you want to do 10 contracts, one contract. You can put negative numbers in here to mean sell. So, and you'll see the profile here on the right sort of changing with your choice of trade. So if I want to trade a straddle, for example, longer call, longer put, key that in, and you see there's my straddle. And then if I don't want to, and I'll put it back to what we had before. So you can key in the strategy there. I'll elaborate a little bit more on this on the next pages, but very quickly, what we do have is that I give you the probability of exercise, so close to 70% chance of exercise for this particular option. We put the Greeks here, and the option premium here is down the bottom as well. So you have to remember that the option price is a unit price per share. So you have to multiply this by 100 because you get 100 shares per contract, per option contract. So if you were to buy this contract or buy a solid contract, you'd have to pay $680.50. You can sort of see the delta here. I'm sort of 70 delta. So that gives you an idea of, it gives you a rough idea of probability of exercise. But actually put down the exact probability of exercise here. But you can see it's very close to the delta. Now, this is really good for assessing what does my payoff look like? What will happen at maturity? Now, if you don't want to see what happened at maturity, you say, well, how does it look like now? You can change the time here, change the time to expire to what you want it to be. You can start to see then that this payoff then will sort of show you the difference between the payoff at expiry and say when you've got 1 year to go is time value. So you can get a feel for how the time value of your option is impacting your price. Now this page, I'm going to leave it at maturity, but I'm just making you aware you can change that. You can also sort of view, well, what does my delta look like at maturity? What does my gamma and what do the other risks look like as well? Now I'm going to leave this on price, but I just want making you aware that you can see other things. Now, when you're looking at the 3D prices, this is kind of then showing you, giving you sort of a sense of what was the scenario. What if stock prices fall? What if stock prices rise? What will my price look like in the future? And you can sort of see the time decay sort of coming into play. Now you can also sort of see, well, how does my delta behave over time? How does my gamma? So that's quite helpful actually. So there's your delta, there's the gamma. And I'll leave this on price. Yeah. And again, I guess if I put in if I just as a quick example, if I put in a straddle, oops, so long call, longer put, you'll see how the price profile of a straddle looks like. So over time for different, and we can sort of play around with different strategies. We can change the strikes. We can play around with the ball. So really useful for sort of gaining intuition. So I'll reset how it was. Now, so this is European options, and now what I really like, this is what this is the pages that I really like to work with. So yes, I can look at the payoff profile, and we can look at the risk sort of scenarios, the what if scenarios in the 3D views as well. But this is the page that I like to work on. So I pick my strategy here. So it defaults the call option, but let's just say, for example, let's use Straddle. Then I update, and then press update, and it's going to populate these defaults. And then I can sort of, and then I price my Straddle. Now, what I really like, one of the really good things about working, being able to do this in Excel, that's a lot harder to do sort of you're on trading broker platforms, is that you can't easily sort of customize your prices. So in this case, what we're sort of seeing here is that we're going to have to pay an option premium of $873 if you want to buy this straddle. And straddle is very expensive because you're sort of buying two options, you're paying double vol. So what we could do, we could sort of say, well, what if I only want to pay $500? Where would I need to place those strikes so that I only pay $500? So if I make this a strangle, I'll make my call slightly out of the money and my put slightly out of the money too. So that one goes a little bit lower. You can sort of see that's worth now $240. But maybe I'm not happy with it sort of being sort of 10 below and above. So let's just say, okay, I'm happy to pay $500 instead of the, what did we say, 900, I think it was. Yeah, 873. Yeah. So instead of paying 873, it's well being out the money. Let's have some kind of compromise. But I don't want my strikes to be too far, not so out of the money. But what would my difference? How would I have to move the strike? So let's put a difference column here, and I'll put a number of 10 in there just to start it off. And I'll just sort of say, okay, call plus 10. And I'll do put minus 10. So, okay, I'm out of the money, but that's 241. But okay, it's a bit further out than I'd like it to be. And maybe I'm happy to pay up to $500. So what you can do is use goal seek. So if you go under, it's under data, what if analysis here, there's a goal seek button here. Now I know the shortcut, which is Alt-TG, so I'm going to just use that. I'll just tell you where it is. So you pick what you want to change. So I want to manipulate the total. So I'm going to do Alt-TG, go to goal seek. I want to change the total. I want the value to be 5. So remember, this is unit price. That's $500 because you have to times by 100 by changing this difference. And he's going to find this difference in strikes such that this is now going to be worth $500 or 5, right? So there you go. And now you sort of see, instead of, I only need to move my strikes by $4.7, which is here. And that's the beautiful thing about Excel is that it's really easy to customize. You don't need to know how to program. You just use goal seek, and that will then sort of solve other differences the difference that you need to apply. So then I can trade the strategy. It's going to be with I buy or sell it for $500, and it's picked and it's set the strikes for me, which is perfect. Now I'm going to show you a different one in a moment on the American options, but. Straddle is a very popular one to use it on, and the other one is also risk reversal is another one which we also like to work with. Okay, right. So now let's jump on to the American options. So first thing, what we've got on this page here, when we were talking about the theory in our last sort of class, the real what this is the Cox-Ross-Rubenstein model, which we've already gone through. So I'm not going to go through this in great depth, but I will just give a quick recap. We built a stock price tree, which is what we sort of see here, and we give details on that in the last video, and then we work out the intrinsic value, which is just the difference between the spot price and the strike. And now this is the put, so obviously anything up when the prices go up, you're not making money. When the prices go down, you are. So you're seeing the intrinsic value when prices fall of the option, and that's there's no time value there. That's just a pure difference between the spot price and the strike for these different nodes, stock price nodes that we've already sort of built. And that's basically the probability of exercising now, where you give up time value and you only and you're just going to have the intrinsic value only if you exercise immediately. Then we also then work out using the Cox-Ross-Rubenstein model. What would be the continuation price? What is the price of the option if you were to not exercise? What's it actually worth? And what this is showing is that when it lights up in red, it's telling us that it's optimal to exercise. That's how I've set this up. So saying, yes, you should exercise at the first opportunity that you get a red. And these are representing sort of future states and times. So these are like paths across time. And it's sort of saying if the price falls up to this point, you exercise straight away. If it goes up and then falls, you should exercise then. And so it's telling us when to exercise. And then this last table here is taking the maximum of exercise now versus continue and hold. And that's how we price our American options. Now, call options, American call options, and put options, they're generally not optimal to exercise because you could just sell them and keep your time value. So most people don't exercise. Now, when you would exercise, it's not it's not that common to exercise, but call options are exercised early. If you call when you hold an option, you don't have the right to any dividends on the underlying stock. And so sometimes if there's a very large dividend to be paid, such as what you might see on ExxonMobil, you might choose to exercise your option because the dividend value of the stock might be worth more than the value of the option. And so around the ex dividend dates of the stock, you might find that the call options, if you have a very large dividend, that people might prefer to exercise because the dividend's worth more on the stock. So that's one case. So if the stock's not paying dividends or very low dividends, it's just never going to be called early. And that's for calls. And you can sort of see this in this workbook because if I put the dividend yield here, and I set that to 5%, you see the carry is the risk-free rate minus the dividend yield. Now this call option, it you can sort of see here from the reds, it's telling us that the exercise value above, so you see 13.19, 13.448. If you exercise right now, you get more money because it's accommodating for the fact that the dividends. You'd be better off exercising now so that you can receive that dividend than sort of continuing and just holding the stock and hoping that you will make more money from the time value of the option. So it's telling us to exercise, and that's being factored into the price. Now, if there were no dividends, if we put it here, then it's just not optimal to exercise early, and you just see there's no red anywhere. And in fact, and then in that case, because it's never optimal to exercise an American call option if there's no dividend, then the price of the American option, the European option, should be exactly the same because there's no benefit of exercising early. Now, likewise, now it's a different story for puts. Puts are a bit different. So if you exercise a put, you're going to get the strike price. You sold stock and you're going to get paid the strike. And the only time that the put option is worth optimal to exercise puts, and it's more often optimal to exercise puts than calls, would be if the option's deep in the money, meaning that there's very little time value. Then maybe in some cases it's better to receive the strike when you sold your stock for the strike price. Sometimes the value of putting that strike on deposit and accruing interest in the bank account could be worth more than the time value of your option of waiting to maturity. So in that case, it would be optimal to exercise. And you can sort of test that here. So you put the dividends back on. Or maybe put them back off. It doesn't really matter for put option. And what we're going to sort of, I'll restore this actually. Let's do that. So, and the case here is what we're saying is, if you look at this put option, it can be optimal to exercise, as we saw. Now, that's because you can put the strike on deposits and earn more money because it's 5% interest. But what if there's no interest? So let's do that. If there's no interest on the put option, there's no benefit to exercising early. You might as well just keep the time value of your option. And then you sort of see that, oops, what have I done? Oh, because my carry is, do that. And then you see then it's never optimal to exercise early because there's no advantage of sort of putting your cash on deposit. Now, that's the really nice thing about this workbook. It's sort of helping us to have some intuition about when we might be assigned, when people might assign against us if we're selling options, and when we might exercise ourselves. Although you can always remember, if instead of exercising, why not just sell the option, capture your time value and the intrinsic value. So I guess we talk, and so that tells us, what we need to watch out for when we're trading options as well. So if I'm long an option, maybe I should exercise the option to receive the dividend. So you should pay attention around ex-dividend dates. Should I exercise my option because maybe the dividends are more valuable than the actual option itself? Now, I've got a second workbook here open, which I'll just show you very quickly. It's the same workbook with what we sort of see here. But what I've done is I've extended it so you can have sort of many more time steps. And this is the Cox-Ross Rubinstein tree. Now, we only did 10 time steps. So if you extend to around 50, you're going to get quite a good price. The more time steps you have, the more accurate your pricing will be, generally speaking. And you can see all the same trees. I'll reduce it down to 10 so it's easier to scroll. So you can do a lot more. You can increase the accuracy and sort of play around a lot more. So if I actually put it up to sort of say 25 time steps, and then we can look. Now this is really useful because now it's sort of you can visually see um, when you might be assigned against in this workbook. So when stocks sort of drift into these regions, and you can see the stock levels here on the top, then then it's optimal for people to exercise against you. And so these are the regions that you need to watch out for when your options are drifting into these regions. You may get assigned. So this is really helpful for us to sort of know what to watch out for. And it's just the same thing, but just with many more steps. Okay, so we won't elaborate too much more on that one, but just to make you aware. Now, we've done the same thing here then with American options in 2D, where you see the payoffs. This is just the same as the European one, but with American option pricing. Now, the difference sort of in here now is this is where you can sort of see there's not really one size fits all for American options. I mean, in terms of pricing, I typically use a tree for everything. This one up here is the Bergson Stenton approximation. She's pretty good for pricing. And then I've got the Monte Carlo, least squares Monte Carlo here, and I turned it off because obviously it's going to be a little bit heavy. You sort of see I get a similar price. Now I can increase the parts here. Obviously, it's slow down. 1,000 parts is not very long, so typically you need sort of 20,000 parts. And if you've got a good um, if you've got good infrastructure where you've implemented sort of quasi-random variables and Brownian bridge, this can be quite commonly sort of 5,000 if you've got a good implementation. Um, you typically, so otherwise you're sort of needing around sort of 20,000 simulations, and that can be a little bit heavy. But for one option, it's completely fine. If you want to do sort of 10, 20, or 100 options, then things get a bit heavy and a bit slow. So I'll turn it off. So there's a Monte Carlo method here, and that's really helping us sort of benchmark our prices. We check the methods against each other. Do we get the same values? And the preferred one, my preferred one, then is to use the Lisa-Riemer tree. 50 time steps is plenty of steps. It's very fast. It's very nice to work with. If you do more steps, it's more accurate. And just to make you aware, I've got other pricing methods in here, and you can actually play around with them and use the one that you prefer. Now, again, there are trading strategies under here where if you want to have more strategies, you just put one one to go long one put, minus one is obviously to go shorter put. So the numbers here it can be plus or minus. But I highlight the ones in yellow when they're active, just so you know which legs to look at. Now, that's the same as the European one, apart from the fact that we're pricing with a different pricing formula. Now, this is the same thing again. It's 3D. So if you want to sort of view the scenarios, what happens if the stock prices fall? What if how do things look like over time? And again, you can sort of see all the Greeks as well. So that's all there. And then you've got different methods as well. So the tree methods and the Monte Carlos and the long stuff shots all there too. And then the trading strategies. So now this is what we were looking at IB Broker. We had different sort of all the different strategies we saw before. Now let's look at we looked at Straddle over the European. Let's do the same thing, but maybe with risk reversal and just to get some intuition around here. Now one of the things it's really nice being able to sort of price things in Excel because you can kind of structure your deals to do what you wanted to do. And another sort of important sort of thing that we like to structure is the straddles. So not straddles, risk reversals. Risk reversal basically is a synthetic long stock or synthetic short stock. So when you're longer call, longer put at the money replicates a being longer stock. And if you do the other way around, so you go short the call, long the put, then it's replicating the short position. So a synthetic position. And this is something that people use in the poor man's covered call, where you want to trade a covered call, but you don't want to sort of put margin down on stocks. You trade the option, and when we trade a risk reversal, so representing a long stock position or a short stock position, the margin that you put down on it's a lot cheaper to margin on the options is cheaper than sort of purchasing the stock outright. Another way of sort of replicating the stock would be to buy a deep in the money call. So if I calls there, that's going to replicate a stock too, right? And that's what they use in the poor man's covered call. So instead of having a risk reversal, you can also replicate stock positions by having a deep in the money call. Or so there are quite a few different ways to structure these things. Now, if I return to the risk reversal, the reason why I want to do this is that I'm long a call, short a put. I have to pay for it. I have to pay $430. $439 in this case. Now, the nice thing is we can structure this to what would I need? Where would I need these strikes to be for this to be free? I mean, I'm buying something, I'm selling something. Why they're not offsetting? Right? So what we can do is, again, we can subtract, sorry, it's the other way around. I add something to the call, make it out of the money, and I take something away from the puts to make it out of the money too. So this is my ship. I'll start with $10. So that's 191. And now we can sort of solve again. So you can use the solver. So you got data, what if, goal C. You say you want this total. I want it to be free. I don't want to pay for it by changing this shift. Where would I need to place that to make it free? Oops. There we go. That's a pretty big shift. I don't think I want to do that. But the idea is that it's possible to do that. Excuse me. So I just put it back to say 10, or maybe 5. So there's my risk reversal. Now, one of the main uses of risk reversal, like anyone sort of following the sort of the gold sort of rush that we've had recently, so gold sort of rushed up to sort of 4,400 mark. It's priced quite a bit at the moment. And we had sort of a lot of the market participants watching are, well, okay, there's going to be a big retracement. We were expecting it. And so how do we sort of trade that? And one of the ways of trading that was let's go long as let's replicate being long a stock just for the sake of actually I'll do it like this. I'll go long a call, deep in the money call. There you go. And that will replicate being long the stock. So imagine we're long gold. There we are, we're long. And now I want to have I can place a stop loss order and a take profit order as well. And the problem with the problem with placing the stop loss and take profit, if the stock sort of suddenly sort of gaps down, it can go straight through your stop loss and you get executed at some really terrible price. And the thing is, if instead of having a stop loss, you just have a put option, yeah, it's a guarantee. It acts like a guaranteed stop loss. So what I can do is, if I could buy a put option, say at 80, and that will protect my downside here. And you can see it on the chart. So I'm protecting the downside, but then I've got to pay for this, but I have to pay for it. Now, maybe it's not 80, maybe I don't want it to fall so much, right? So maybe I only want it to fall to 79.95. And that's going to cost me $90 for that protection. Now, if I don't want to pay that $90, maybe I'm trading not just one call, maybe I'm trading 10, and that would be $900. Now, if I don't want to pay the $90, I can go short a call, and that could be my take profit. So maybe I think, okay, the call is currently at 100, and so maybe it goes to 110. I could sort of take profits at that level, and so I could sell that option and not feel bad about sort of giving up the upside because I just don't think it's going to go above that, right? And so, and then I'm getting sort of these $2 to offset to pay for my protection, and then maybe I put the protection even higher as a result. And then we can use this goal seek then to solve for these levels. Maybe I only need 90 cents from this trade. I don't need to give up so much of my upside. So I only need 90 cents here. So we could then sort of goal see, how do I make, what strike do I need to set this at to make this minus 0.9 to offset, right? By changing this strike. Now, that's the really nice thing about being able to do this in Excel. And you can sort of see now, I've been able to structure this deal. Oops, I didn't keep the value. Let's do that one more time. TG, go seek. I want it to be minus 0.9, 90 cents. 0.9 by changing the strike without clearing it. So one was 601. That's okay, we've kept it. And now you can sort of see I take profits for a much, I take more profit basically because I've set my strike much higher. So, and if none of these options expire, say they don't trigger, say they're not, the probability of exit is still only 50%. If they don't actually trigger, I just do it again. Now, what we could also say is actually, well, how about we do this option selling to make profit? Maybe and so you can structure this to say, okay, what if I want to make $1, say, so go TG, and then now I'm going to say 1.9 by changing the strike. Where would that be? And you can sort of say, maybe I'll make some money on this instead. So again, that would be at 110. And if you think that 110, you don't think it's going to go above 110, say for example, then this would be a good level to place it at. And then if we've still only got sort of 25% chance of exercise, or 27%. So if it doesn't exercise, great, we just sell it again. And then we just make another dollar. Now this is $1 per share. That's $100, right? 6 times 100 because it's 100 shares per option contract. And so basically what I'm trying to sort of say through all of this is that being able to do this in Excel and match the prices in Ivy Broker allows us to sort of structure our deals to achieve so we can maximize our profits and minimize our risks. So we can sort of maybe then place out a guaranteed stop losses at levels that are better for us rather than sort of taking losses all the way down to 80. In this case, we can sort of take losses just to 95 and have the call option pay for it. So that's fantastic. Right? So yeah. So basically, you can actually make money on guaranteed stop losses and take profits, which you couldn't do by placing sort of a stop loss and take profit order. You don't get paid for those, right? But you could structure your take excuse me, you can have a guaranteed stop loss, guaranteed take profit, and be paid for it. And if they don't reach those levels, just roll them over and be paid again. So it's absolutely fantastic, right? So it's a great options that give you a lot of flexibility, and being able to sort of price them in Excel and structure your deals to maximize these profits is fantastic. And this workbook allows you to do that. Now we're going to finish off on the last sort of slide, just to confirm what we went through already. So I've taken some screenshots of IB Broker. It's the one I showed you in the PowerPoint slide. So it's ExxonMobil. It's all stock in the US. It was trading at the time 111. It's around 1114 114 at the moment. I was looking at the November, the calls on the left, puts on the right. I was looking at the 95 strike for November, and we saw the bid offer was 56 and 62. So $56 to sell and $62 to buy. I keyed in all the parameters sort of match IB Broker, and pretty much almost all of the parameters you can get off the option chain itself. And what's difficult to find is the risk-free rate and the dividend yield. So the cost to carry here, B, is the risk-free rate minus the dividend yield. And that information is a bit tricky to get a hold of. So what I've done here is on the left, I've shown you where to go to get this information. So the option chain, you get the spot level in prices in the vol. And it's a bit difficult to get this risk-free rate. So to get that, you have to go into IB Broker and you go to the model navigator. And when you're in the model navigator, it looks like this. And then in the top left, IR, you can see the interest rate being applied to the option, to your option, and you get a table then of dividends as well, and you get dividend information in here. So when you want the dividend information, you come to the screen, the model navigator, and you just right click in the platform to find that. So that's where you go for that information. Everything else you can get off the screen. We know that the top right tells us the spot levels. So you can see the spot levels here. You see the strike, 95 strike here. You can see it's 73 days here to go. You divide the 73 by 360. They're all actual 360-day count basis. Now, the vol that you want to use when you're replicating the prices in IB Broker is not the at-the-money vol. You want to use the vol for your strike. So you have to add this column implied vol, and this will give you the vol for your strike. 27.8. That's the one you need to use. You key that in, and then you'll get you find the option price, then will lie between the bid ask. It won't exactly match on the bid or ask because they don't give you the bid ask vols. They just give you some kind of mid vol, which is very normal. So you should find that your price is between the bid and ask. You may find the bid ask is skewed, so you might find your price is closer to the bid or the ask. Don't be worried about that. It's completely normal. Market makers do skew their prices. So because they want to they want to sell an existing position and things like and clear their books, or they sometimes lean their prices one way or the other accordingly. Now we got the probability of exercise 10%. So it's a brilliant option to sell. We really don't think it's going to hit that level. With 10% chance of exercise. So we think, and then we get the Greeks as well. And these Greeks you find 8.69. I think they've got something like 8.9, something like that. Yeah, 8.9 here. So you see the delta again. And that's only different again because we don't know the exact implied vol to use. We only know the mid. And you get the other risk there, and it tells you option price per premium. So this is to show that we are matching price. So you can see the price chart here. Put that there for you as well, so you can sort of see where things were, whether this option sort of makes sense in trading or not. I'll leave that to you. Now, go back to that screen. Sorry, there you go. So this was just to confirm that we do match the prices in the market with the analytics that we have available in this workbook. We talked about that we have the European options for US index options, and then American style options that are the individual stocks. European options can only exercise at maturity, American options can exercise at any time. And so we have to then assess, perhaps using the Cox-Ross-Rubinstein model, when is it optimal to exercise? And we want to exercise call to receive dividends. That's the only time we want to exercise a call, and the only time we want to exercise a put is when you want to put the strike on deposit. If interest rates are high. If interest rates are low, then there's no need to sort of think about that too much. And then when it comes to actual exercise, you have to also then weigh up, maybe I just sell my option rather than exercise. So you have to factor in all those things. And then the main thing was to say that this option strategy paid really useful for solving and structuring our deals to sort of meet. So that we want to sort of ideally be able to customize our premiums. We want to sort of reduce the premiums if you're buying. We want to try and create structures that where we don't have to pay anything for, where they're free to sort of enter. So it is possible to set up use risk reversals to set up take profits and guaranteed stop losses in such a way that you get paid as well. So there's a lot of things we can do when we're customizing our option trading strategies to maximize profits. And it's very convenient being able to solve for the right strikes to achieve the right premiums in Excel. I think this workbook's really good for that. And the one thing I would sort of say, if you want to customize these strategies here, when I'm pressing this update button, what it's really doing is here in the strategy pages, it's copying across these templates. But if you want to sort of put in live data from Bloomberg or from your chosen data source, you can actually put your data formulas into these templates, and then when you press the button, it'll load up with all your live data. So I haven't put in the live data for you. It's for you to sort of try the key in those prices by hand, which is not a big deal. It's only a handful of parameters, or you could incorporate Bloomberg formulas into here or your chosen sort of data source. But if you do want to update the strategies and modify them so that they don't default to the values of 100 and actually to the values of your underlying stock, you can key in the Bloomberg formulas in the strategy area here, which is underneath this plus button. So just letting you know where it is. Okay, so returning to the slides, here we are. So we've gone over then how do our prices match the market, and why do we then want to sort of why would we bother doing anything in Excel? And as I said, it's just so you can structure your deals, try and reduce the premiums you have to pay for your options, and maybe set your strikes in such a way that maybe to earn additional income or reduce your costs, basically. So it's many reasons why we might want to structure our deals, but it's all about maximizing profits and minimizing risks. So we can do all of that in Excel. The goal seek function is pretty good for that. It works very quickly in our Excel workbook, and that was everything I wanted to show you about the workbook. Now, in terms of more information, if you want more information about trading strategies or quant research, there is you can subscribe to my newsletter. It has a really good archive where you can go through sort of previous editions, and you can search for Monte Carlo, American options, and quite a lot of other things. You can also subscribe to my YouTube channel, where I do post a lot of videos on quant content and algo trading. There's the premium content can be found on the Algo Trading Quant store, and you can follow me on LinkedIn. So I hope you enjoyed the session. Please do subscribe to my YouTube channel, and I'll see you again soon. Thank you very much for your time.